All right, so let's go ahead and get started. So last week we had one of the first big down weeks we've had in a while here in the markets, and that's really continuing today. Obviously, the big news being the trade war escalation between the U.S. and China, and we have to go no further than Twitter to see that our old president here is stoking the trade war flames. But it was actually interesting because one of the things that set today's decline off was the yuan weakening overnight. So the Chinese essentially have responded, and let's see if I can find a good. This may be. Let's look at the currency. Yeah. Can't seem to type today. So yeah, I was hoping to find a chart of it here. I seem to be losing my place. But in any case, the renminbi, I don't even know if this is the right chart. Yeah, this doesn't look like it. But maybe if we do, let's try all here. The renminbi obviously weakened overnight, or the Chinese yuan, as we also call it. So you can see that the Chinese essentially have, these charts are not what I want to see. Anyway, the Chinese yuan has been weakening. Let's see if we can find another chart here. And that means that the Chinese have essentially been letting this devalue. And so if we pull up a chart here, you can see that the Chinese are responding to the U.S. trade war by letting their currency weaken some more. And basically what that's doing is it's making our side mad. Here you can see it, finally the right chart. So they let this weaken overnight, and it looks like, most commentators seem to suggest that this was done on purpose. And so by weakening their currency, this is the Chinese response, or at least part of their response to the U.S. saying they were going to tax more Chinese goods. So this trade war is escalating. As you probably saw if you were paying attention to the market today, we had about a 3.5% decline on the NASDAQ and about a 3% decline on the S&P. And we got a little bounce there at the end of the day, but pretty much just massive selling across the board for the most part. Very few stocks were in the green today. Particularly hard hit were some of the Chinese stocks. So, I expected this last night, but we saw, we saw a lot of the, like Baidu obviously being one that I care a lot about, was off about 7% today. And we also saw stocks like Ctrip, JD, basically a lot of the major Chinese stocks were off more than 5 or 6% today. So pretty big moves here in the Chinese stocks. And unfortunately, they're taking the brunt of a lot of this selling. So that was unfortunate, but it's also interesting because I think a lot of these stocks are cheap. I can see when I look at my Seeking Alpha watch list here, you can see like a lot of these like Sogao, this is Chinese stock. This is a Chinese stock. This is a Chinese stock. Weibo is another one, Chinese stock. Baidu, they're pretty much at the top of the list of decliners here. JD here, YY. So I think, these were already fairly cheap stocks. I think there's probably maybe some more pain to be had in the near term, given that this trade war escalation probably doesn't just stop all of a sudden. So I'm being really careful and cautious about buying some of these Chinese stocks. But anyway, as we get a deeper market sell-off, there's going to be lots of potentially interesting opportunities, both in and outside of the Chinese names. So, I'm just really building the shopping list, and that's what it's all about right now. So that's kind of where I'm at with, the market sell-off, just being really cautious because, again, we're still, when you look at the charts of the S&P, we're still, not that far off of where we were, just a month or two ago. So, this sell-off looks pretty bad today, but, for context, we're still not that far off of all-time highs. We're only we're in about a 6% sell-off or so now. So the S&P is still up, I think something like, 12 or 14% year to date. And the NASDAQ's up like 18% year to date, something like that. I have to look at the exact numbers, but so, the markets are still up for the year. but definitely giving some of those gains back. But I think, if we get an escalating trade war situation and, not a lot of fiscal policy support and things like that, then the market could definitely take a deeper dive here. So just being pretty patient so far, but getting the shopping list ready and kind of waiting to see, what the next shoe to drop looks like. In addition, we're getting lots of news on companies because it's earnings season, and we're getting conference calls, and we're getting earnings releases, and we're getting analyst reports and target changes. So there's a lot happening in the market. We forget that the Fed actually lowered rates last week, right? I mean, that was on, I think, Wednesday. They lowered by 25 basis points. It sounds, or it feels like it's already, that was a month ago. But, in terms of the macro data side, things not really looking super, super great, to be honest. We've had relatively weakish, macro indicators coming out. The yield curves are still getting worse. So, like if we look here on Koyfin at the yield curves, you can see the 3-month 10-year yield curve has gone negative again in the U.S. You can see the German yield curves are continuing to invert as well, or at least move towards inversion. So there's just signs that, economically, globally, we're maybe in some trouble here. All the ISM manufacturing trends seem to be pretty weak. We got the ISM manufacturing data out of the US last week, and that was pretty weak. So let's see if we can pull that up here. So that's just not, that's not great. We had the non-manufacturing ISM out today, and it was a little bit lower than consensus. But when we look at last week, like I said, this is just a trend that's happening with most of the manufacturing indices globally. You can see the ISM manufacturing PMI here, and it's trending in the wrong direction, right? So this was actually a little bit worse than consensus as well. So that's not helping things. And it looks like we're going to need more Fed rate cuts. The market's already pricing in another rate cut in September. And who knows what else we're going to need to help reignite growth. There's another GDP estimate called the GDP Now. Let's see if we can pull it up here, which is it's sort of like a forward GDP estimate, and it looks like it's decelerating as well here in the US. So you can see that a lot of the indicators starting to roll over. No, the one thing that's still positive is jobs data. The non-farm payroll data has been pretty good. And so the unemployment rate is still like 3.7% here in the US, which is, quite low. It's like near 50-year lows. So right now, none of these indicators have started to create like massive job cuts. But I expect that towards the back half of this year, if earnings continue to roll over as a whole, and especially on the manufacturing side, I think we'll see job losses start to accelerate. I believe who was it? Ford last week mentioned that they wanted to cut some jobs, and so there's some cutting happening already in the manufacturing sector in places like that. But it may not even been Ford; it may have been someone else. But in any case, yeah. And then the energy sector obviously has been really weak too. So, yeah, I'm a little concerned about the global environment right now in terms of, stock markets and that that gives me that patience and that pause to kind of see how things develop before I get too aggressive in buying. As I mentioned in the channel today, I raised a little bit more cash in my own portfolio, so sitting on about 38% of cash in my portfolio, which I think is a good level. Almost 40% means we've got lots of dry powder for, opportunities. I didn't cut any of my core positions, like, my larger core positions like Baidu or MassRich or Dropbox. We get Dropbox earnings actually on Thursday. Now, this is one that some have been worried about because, they did have these price increases that went into effect last quarter. And we don't really yet have good data on, what retention looks like with those price increases. So there's been some people obviously upset about the price increases, some consumers trying to give up their subscriptions, and some evidence that Dropbox is rolling back its price increases on certain customers. So there's this article here on Seeking Alpha that talks about that. I think they were being a little bit too bearish there, but still, I think it's going to be really interesting to see what the Q2 performance looks like, because we're going to have an idea too of what how consumers in aggregate really are reacting to the new Dropbox price increases. So pretty big earnings report on Thursday there that I'll be watching pretty closely. So there may be some trade implications depending on what happens. But again, I don't want to make any rash decisions ahead of that. So I'm holding on to my position for now. But yeah, the stock's selling off the market too. Tech in particular, like I said, had a worse day because the valuations are worse. So you can see the NASDAQ's been declining. Same thing last week, the NASDAQ declined for the week about 4%. Whereas the S&P declined about 3%. So tech names definitely taking a bit more of a hit given how overextended they were on valuations. And then last week in terms of earnings, we had a couple that I'll call out, obviously a few from our watch list. One of them was EA. I was actually just taking a look at their results again. EA has a lot going on right now. They've got their Madden launch basically is out again this week, their new version of Madden. I think their new FIFA version comes out next month. So pretty big releases for them. Their quarterly results for Q2 looked all right, actually. Revenue was decent, but profit margins actually looked really good. So I thought that was a bright spot for them. The stock didn't really react positively. Part of that, I think, was market driven, but they got a few upgrades from analysts, and I think they got maybe one downgrade, but net, I think they had more upgrades than downgrades. But you can see here their revenue growth year over year was like low single digit percentage. I think it was about 1% year over year in total. So, you can see that mobile is really an area of weakness for them right now. Console and PC are doing pretty well. And together those are, growing about double digits year over year in total. But that mobile decline is really hurting them at the moment. So it'll be interesting to see if they can turn that around. But overall, I think things looked okay. And let's see if we can see, I'll show you guys. Yeah, so here's obviously the launches they've got coming up, which these two are by far obviously the biggest. But I thought results looked okay. See if I can show you the profit margin levels. The good thing was they did keep expense growth in check, and so that's helping them deliver like the earnings that people expected, and pretty good free cash flows. They're buying back stock. They've got like I think they've got something like $5 or $6 of net cash per share on the balance sheet. So really strong balance sheet, and stock isn't really that expensive. So it's one I'm watching. It's definitely on my shopping list if things sell off. I think this would be pretty compelling, like in the low 80s or high 70s. So right now we're still kind of, right around that $90 level. So I've just been waiting to see if we can get this thing a little bit cheaper. But overall, I thought results were okay. And then Macerich was obviously, they had, I was really pleased with their results. So they, stocks off about 3% today, but the results that they had, I thought were pretty good. And they just kept reiterating on the conference call that basically there's going to be no cut to the dividend, that, everything's really healthy. Their releasing spreads are really good. All of their new tenants that they keep signing up are fantastic tenants. And, while they've got the bankruptcies of Sears to deal with and a few others, they're able to replace a lot of those tenants with a lot more high quality tenants. They've got like WeWork coming in, they've got movie theaters, they've got higher end restaurants like Nobu and a few others, and they've got they're doing corporate office space and mixed use. So there's a lot of really interesting things. I was hoping I could pull up their slides here. I don't know if I see it here though. Let's see if we can pull up their slides. But yeah, I mean, I thought overall the release looked really good. So I was pleased to see that. Yeah, and I mean, there's still, occupancy is really solid, 94% occupancy. Average rent per square foot was up 4% over last year. They're doing some incremental financings at pretty low interest rates on some of their properties that don't have a lot of debt on them yet. So that's freeing up capital and allowing them to reinvest in new projects and project redevelopments. You can see here releasing spreads, which basically means like any tenants that need to be signed to new leases, or any tenants that are giving up leases and they're re-signing new tenants. So those are actually seeing pretty nice growth in terms of rates, and so that's very positive to see. Annual square sales per square foot up 12% in the last year. So really just pretty much all around the numbers look pretty good. And again, yeah, they've got less than we're paying less than 10 times FFO, which is really cheap for a high quality REIT. So yeah, that's what we saw there. And like I said on the conference call, they just kept talking about the fact that they feel really good about their releasing, their new tenants, the project redevelopments they're doing. Everything seems to be trending pretty positively. Even the Sears stuff that they're recapturing, they're just really excited about getting better tenants and higher leasing rates. And so I thought there was pretty much just positive stuff in the results. Yeah, I mean, other than that, let's see, I think FCAU, this was one I actually trimmed. I think the stock is still incredibly cheap, but it trades for like 5 times last 12 months earnings, but this is definitely one that could be sensitive to a recessionary environment, but as well as like a trade war, could create some problems for them, because China, is an important market for them, a growing market for them, but also, they're sourcing some of their sourcing happens in China as well. So there could be effects there. Obviously steel costs and things like that can hurt these auto manufacturers as well. So I'm just being a little bit cautious about my position size there, given what might be happening over the next 12 to 24 months in terms of the economic environment. But yeah, I mean, I thought the results, the thing that we saw that was encouraging here was that they pretty much just reiterated their profit target for the year, despite the fact that they are seeing some revenue, some top line weakness. So Q2 of this year versus Q2 last year, they're seeing a decline in revenue. You can see that about a 3% decline in revenue in Q2. A lot of that is coming from just a reduction in total shipments and total units, offset by some price increases. They're doing really well in the Jeep and the Ram brands. Here you can see this is how the profit has developed over the last year. So yeah, you've got a headwind in volumes, but they've been able to control costs really well. So that's helped them essentially actually deliver a better profit margin in this quarter versus the same quarter last year, despite a lower sales figure. So, they're doing a good job managing this business. The management team is really, focusing on the things they can control, but obviously having lower sales is not great in the short run. And, if that gets worse, then holding their profit margins stable is going to become harder and harder. So anyway, I think that they reiterated their profit target for the year. We're still talking about more than $2.50 in earnings per share this year on a $13 stock. So in fact, I think officially their guidance is for EPS of greater than $2.70. So, on a $13 stock, you're talking about less than 5 times earnings. So a very, very cheap stock, but those earnings could decline significantly in a recessionary period. So it may not be as cheap as it looks, which is why I just trimmed a little bit of my position, because I think there's some opportunity for us to potentially be able to increase the position later on at a cheaper price. So I'm just trying to be careful too about having exposure to too many like deeply economically sensitive stocks, right? I don't want to be too overweight in like, if you think about the things that some of the stuff that I'm involved with, it's, I've got retail exposure, I've got China exposure, I've got some auto exposure here with FCAU. And that's a little bit scary when I think about all those things being economically sensitive. So I'm just trying to be cognizant of that. And the other thing that I did with, the portfolio was just to trim off any of the non-core positions that I thought, just could be better uses of cash if we do get a really deep market correction. So like Spotify and a few others, that I mentioned in the channel. Let's see if I can pull it up here. Those stocks are, I mentioned cutting Fiat Chrysler, Eagle Materials. I cut a little bit of Urban Outfitters actually, because it's one of the retailers that even though I think the stock is really, really cheap. I'm concerned that some of their brands are a little bit higher end and could take a little bit of a big hit when they face a recessionary type environment. So I'm just trying to be cautious there. But yeah, I cut out of positions like CRISPR and Spotify and Capital One because they were small positions, and I didn't really think they were going to contribute that much to the portfolio. And I figured the cash would be valuable for incremental opportunities. So those were the ones that I had cut out of completely. Let's see. Someone was asking about the current position size on Fiat Chrysler. I always obviously look at my position sizing framework to try to tell me. My position sizing framework, says that I probably shouldn't have cut Fiat Chrysler given how cheap it is. But the thing is, I only cut, I think, about 20% or so of it. So it went from like almost a 3% position, or maybe like a 2.5% position, to like a 2% position. So not a huge move there, but I just wanted to adjust some of it to reflect the near term risk in the market. So yeah, it wasn't a huge move there, but yeah, this is kind of a feel thing in some ways, I guess. Position sizing, even though I have position sizing framework, the numbers are always like guidelines for me, not like hard targets. And so, again, I also am trying to think about it on a like basis of how much of my portfolio is recession sensitive. And so when I looked at like my total exposure to like recession sensitive sectors, it was a big chunk of the portfolio. So it was like a third of my portfolio was in like pretty sensitive names. So that felt high. But yeah, the other things that we've got this week too, stocks on our watch list, like I said, last week we had Macerich, Fiat Chrysler, EA, Huntsman. Huntsman's results looked fairly weak, but that position size is pretty small. Eagle Materials, same thing. They missed estimates. Their revenues are down year over year. I've been cutting out of that position over time anyway. But this week we get interesting reports from Dropbox, Blue Apron, Despegar. I think those are the ones on the list. And then lots of other companies that I'm watching that are not on our official watch list that are reporting. So we get another big earnings report week here. Booking Holdings, we get Fastenal, Wynn Resorts, Invitae, HubSpot, Lyft. I think Uber reports as well. Get companies like Melicado, Libre, and who else? Zillow Group. I'm looking at, I think Kronos reports as well. CBS, Overstock reports, Yelp reports, TripAdvisor reports. TripAdvisor is one I've been poking around on as well, but I don't think it's quite cheap enough. Roku reports, a couple of the miners report. So the miners have been doing really well. We've talked about this quite a bit, but silver and gold have been performing. You see them here up in a pretty ugly market here. So these have some breakout characteristics here, and I'd be curious to hear Nikki's take on it as well from a technical perspective. But silver and gold stocks have been working. Mining stocks have been working. Some of those report this week. I think Pan American Silver reports this week, and a few others. So that's interesting. Hecla Mining as well. But yeah, these things tend to be working. And also Bitcoin, right? Bitcoin's also showing some negative correlation to stocks here, which is really interesting. So that's kind of comforting actually, because it's nice to have some assets that we can have some negative correlation with stocks, like, and just every other asset class that's been trading together. It's nice to have some stuff that's doing the opposite. So people, I think, are starting to find Bitcoin and gold and silver as places where, in a negative to low interest rate world, places where they can park money and potentially even get some decent return. So I don't own any mining stocks right now. I tend to not really love mining stocks because they're not most of them aren't managed very well. So oftentimes, for me specifically, I tend to focus on if I want exposure to the sector, I just tend to own the underlying commodity. But I think that those stocks have been doing really well. So if you're involved in those, I think, keep riding the momentum from my perspective. But yeah, so that's earnings reports this week. And then in terms of macro data, it's a pretty light week as opposed to last week, which was a pretty heavy macro week. It's pretty light on data this week. I mentioned the ISM non-manufacturing that came out today. There's some China trade balance and China inflation rate stuff that comes out in the middle of the week. The US really doesn't have a lot. So that probably won't be a huge market mover this week. But mainly company-specific news and anything trade war related are going to be driving the markets this week. And then, yeah, I noticed some interesting things. I caught some interesting pieces of news on a few companies that had reported last week. So Square is one that I've been taking a look at. They reported that stock reacted negatively. I think part of that is just due to maybe, the valuation was a little bit overstretched and the growth decelerated a little bit year over year, but not really that appreciably. So if we look at the, financials year over year revenue growth, you can see that if we look at it on a quarterly basis, they had a couple quarters where they were growing 50% year over year. But they grew at 44% last quarter. So I don't think that's a problem. I think that's a pretty healthy growth rate. Some of the analysts were, I guess, a little bit disappointed in the numbers, but overall, I think still some really solid tailwinds there. But again, the valuation was always the problem for me, like when it was trading $70, $80, $90 a share. But the stock has come in quite a bit. So it's down, I think, 15% over the last week. And so starting to get to more interesting levels. I think I'd be interested in this in the 40s or 50s, which would be more like 5 or 6 times revenue. And I think, closer to a, low 20s billion market cap, which I think would be pretty interesting, especially when you compare it to something like Visa or MasterCard that have like $200+ billion market caps. Visa's actually over 350 billion market cap. And then MasterCard is, $262 billion market cap or $260 billion market cap. So, when you think about the long term at Square, can they be as a payment processor for small and medium businesses, and then also obviously having the Cash App on the consumer side, which allows them to monetize payments and various financial services with consumers. The long term, this could be $100 billion plus company. It's just a question of how long does it take to get there. Obviously, this could be a 10 or 20-year story before it is able to get to that type of value. But I think on a long-term basis, Square is pretty interesting. So the question is, at what price would we get involved where we feel like it's a really good value and provides an opportunity for high returns, even if it, is a 10-year story kind of thing. So that's one I'm watching. Management was pretty positive on the conference call when I read through it. So that was good to see. So that was one I was taking a look at. I've been watching Stitch Fix come in a lot. This is a stock that has kind of perplexed me for a while. But Amazon announced that they were starting their own personal shopping. So they're essentially getting into the same kind of business where they do a monthly subscription business for clothing. So that spooked the stock a little bit. And the stock's down quite a bit over the last couple of months. They had a really good report that the stock had popped, I think, 20% on or so. And looked like it was off to the races. It went from, low 20s to $30 a share in like a month. And then now it's all the way back down to where it was before that earnings report. So yeah, this was one that I've started to think about again. But I looked at the Amazon, let's see, what was it called? Amazon Personal Shopper. I looked at it. It looked like, I don't know. I wasn't super impressed by what they're offering in terms of brands and things like this. But, it's Amazon. So if anyone can figure out how to do it, it's them. But yeah, the brands were a lot more like mainstream type of brands. And, so like you've got like your Nikes and Under Armours and Columbia and Clarks and Hugo Boss and, pretty large name brands. But it felt like stuff that you would like these brands seem like the type of brands that like you wouldn't buy on subscription to me. But again, I don't know. I may not be their target customer, and it's early days, so we'll have to see if that takes a bite out of Stitch Fix's growth rate. But I poked around on this and wasn't like super excited about what I was seeing on the men's side. I'd be curious to get some of Nikki's opinions on this one. But yeah, clearly investors are worried about what that's going to do to Stitch Fix. So maybe that gets interesting at some point. What else? I've just been poking around on so many different things, but nothing is really like jumping out as like something that I need to buy today, like pound the table. Mastercraft is an interesting one that I've been looking at. So the problem with this one, like a lot of the stocks I'm looking at right now, is that they have a recession sensitive component to them. And like if a real bad recession does hit, this thing could really get whacked in terms of revenue and profits. And it's got a little bit of leverage too on the balance sheet. So I'm trying to avoid stuff that's got leverage plus economic sensitivity. So that's one of my issues here with Mastercraft is so this I think now trades for about 6 times earnings, but this is a company that owns some of the best brands in the boating and RV space, or actually the boating space mainly, but they own different brands across the portfolio. Some that do like pontoons, some that do power boats, some that do like yacht style boats, and so but they control some of the better brands in the industry. The problem is boating sales get hammered in a recession. So I think that's why the stock is reflecting it. But the stock looks cheap today on its current profit numbers and, has been pretty well managed over the last decade or so. But it's just a question of, can you buy this thing yet? Or do you need to wait for, a recessionary period to really take this thing down to like single digits? So that was one I was poking around on, but don't feel comfortable enough yet. So Cheesecake Factory is one we talked about a few months ago. This one I think is starting to get interesting, not because of its price, like its price is super cheap, but there was a transaction that they did. We had talked about this before, but they actually went and acquired the rest of the restaurant brands that they had a stake in that I think are really, really interesting for like a longer term play. So they bought a company, they bought the rest of the company out that they own part of called Fox Restaurant Concepts. Now Fox owns a portfolio of brands of restaurants that are really fast growing. So a couple of them worth mentioning are North Italia, Flower Child, True Food Kitchen. These are actually really fast growing restaurants that are interesting concepts that don't have that many restaurants actually built out yet. So there's a lot of expansion potential over the next 10 years for them. But yeah, I mean, it's funny actually on the Macerich conference call, they actually mentioned True Food Kitchen as one of their new tenants. So that was funny to see that kind of pop up in 2 different places last week. But let's see if they've got the slides here. Yeah, it looks like they do. So if we look through, they talk about the acquisition. So these are pretty interesting. So they are basically paying about $450 million to acquire these brands, but a pretty relatively cheap multiple given the fact that they can increase the number of units they've got quite a bit, I think, over the next 10 years. So like North, we have one of these in Austin, actually. North is like an Italian concept. It's a high-end Italian concept, but just a really nice, modern, clean concept that seems like it has a pretty interesting financial return profile to it. And then they also have a couple of other, like Flower Child is a healthy eating concept that I think has a ton of potential. It's probably one that I'd be the most bullish on out of all the brands that they're getting. But this one is a concept that we have, I think, 2 locations here in Austin, so I've been able to go check it out. But this one, I think, could be hundreds of units across the country in a couple of years. A really, really good concept. Low price point. Average check, I think, is like in the mid-teens or so. And yeah, it's just a really, really interesting business. Now, part of the problem with Cheesecake Factory, the traditional business, as we know, is like the restaurant chain Cheesecake Factory, is that it is also potentially recession sensitive, so that like because it's such a high-end restaurant, or at least a higher end restaurant, it gets hit in a recession. It's going to take probably some sales and profit hit. And that's one thing that I have to be cognizant of here, of getting like too excited about this. But again, this is really it right here. They talk about being able to grow the number of new units in these concepts by 20% or more a year. And so that can really drive a lot of top line revenue growth on a longer term basis. And that's why I kind of got excited again about this one, because it's not like super expensive. That it's a basically market average PE multiple today trades for about 16, 17 times earnings, which is about market average. But if they've got this growth driver, underlying growth driver in these new concepts that they can create, significant growth from in the next 10 years, that's what makes it interesting to me. Of course, that's offset, like I said, in the near term by the fact that you could have the core business, the cheesecake business, actually hit in a recession. And so I got to weigh those two things against one another and figure out what price does this really become a no-brainer. So that's kind of where I'm at there, just still waiting on that one. Nikki, I don't know if you have any thoughts on it, but
I was going to ask you, I had no idea that Culinary Dropout was owned by that brand.
yeah.
Fox, right? Have you ever eaten there? I actually have been to one, and I had no idea I thought it was an independent restaurant. It was really good. So it looks like the spread of restaurants that they have are just really hip, new, and fresh. And, Cheesecake Factory's kind of, at least, I don't know, for our generation, it's not really the place to go.
No.
Food is the type of environment now that you want to go to with your friends for brunch or whatever. So they're really coming out with these fresh new restaurants, and I like a lot of them. I've been to a few of them. So I was just wondering if you had been to Culinary Dropout.
Yeah, I think I'd been to the one in the Domain once before, and I didn't realize Fox Restaurants own them either.
I didn't either.
So that's another interesting concept as well. Yeah, you can see here, like revenue growth at core cheesecake is kind of underwhelming, right? It's like 1 or 2% a year, and so it's not like super super compelling if like that's what you were buying here. Like I wouldn't buy this at a market multiple in this type of environment, especially. But with the new concepts, I think it starts to look a lot more interesting when you have potentially, multiple levers to accelerate revenue growth here.
Yeah, it's almost like them reinventing themselves.
Yeah, so this one's definitely on my watch list, potentially on my shopping list, because I need to actually run some numbers a little deeper to really get a feel for where I think, like, I want to actually calculate what I think their earnings potential can be in like 4 or 5 years, and take a look at what that means for, price per share versus that today. So I'm going to do a little bit more work on this one for sure. But I thought that was interesting that they obviously see enough value that they went ahead, and I think they had an option to acquire more of this in like 2020 or 2021, and they accelerated it. So they basically bought it out early. So obviously they're seeing the potential, and I think they're, putting their money where their mouth is, so to speak. But yeah, I mean, North does $7 million of sales a year on the average location at 20% operating margins. Like that's
impressive for a restaurant.
Yeah, so they basically it costs like $3 to $3.5 million to build one, but they get like, at 20% profit margins, they basically get a third of their restaurant opening costs back in the first year. So they have a pretty good financial profile in these restaurants, it looks like. So yeah, let me address a couple questions here you guys had. So you guys were asking about Baidu. So Baidu's tricky because there was, I'm glad you mentioned that, because there were a couple things on Baidu this week that are worth paying attention to. One, obviously the trade war. Baidu is a company that gets most of its revenue from like domestic sources in China. So like it shouldn't really get that whacked by a trade war, but I guess there's some risk that, in a really problematic trade war scenario where there's a really aggressive increase in the rhetoric and the tit for tat, so to speak. Like it's possible, there is a small probability that the Chinese stocks that are listed in the US could be affected somehow. And I don't know if that means, you know, threatening to delist them or, you know, creating sanctions on people investing in them. You know, again, I don't know what that looks like, but it's a small probability. I think that should be kept in mind. And so I haven't seen any major comments there yet. There is, you know, Marco Rubio was pushing something called the Equitable Act, which, you know, I've just been watching. It looks like it's going nowhere, but basically he introduced some legislation saying that he wanted the government to basically create higher standards for the Chinese companies that have been listing in the US, because a lot of the Chinese companies have poor disclosure, or they have, you know, less transparent disclosure in their financials than a lot of domestic companies. And so that's what this, you know, proposed legislation was all about. So anyway, this was something kind of unrelated to the trade war, but something like this is a risk for sure. If you know, during this trade war, the U.S. wants to find ways to hit back at China, this could potentially be one of those ways. And so it's something that I'm monitoring. It doesn't look likely that this bill is even going to pass. But again, it's something that's in the back of my mind as this trade war escalation happens. So that is an issue with Baidu. The other one, Baidu specific news, is that they had a ByteDance. There was an article here about ByteDance, which is it's the company. ByteDance is a private company that owns a couple of like really, really popular apps. And you may be familiar with TikTok, which was acquired by ByteDance a couple years ago. But they, you know, they control some pretty popular growing apps that have gotten increased usage in China and elsewhere. And ByteDance has basically said that they want to build their own search engine. Now, at first, that really worried me, but it sounded like when I read deeper that they are building that search engine for search within their own apps and not to compete directly against Baidu and, like, you know, people searching through a browser type of situation. But again, it's definitely a concern when you've got more competition at any level. So there was this announcement that, you know, ByteDance was going to, let's see if we can, there's a Bloomberg article that does a better job of laying this out, but yeah, it's probably going to paywall me. Yeah. So a little trick, if you guys don't know this one yet, you can do incognito mode to get past Bloomberg paywall oftentimes. Sometimes it works. So yeah, this article basically lays out the ByteDance's moves towards creating their own search experience. But that's something I don't expect to take a huge bite out of Baidu in the near term, but definitely incremental competition is a little bit worrisome. And ByteDance has been super aggressive in recruiting people from Baidu and spending money and advertising and things like that. So they're being a little bit of a thorn in Baidu's side, and I don't want to ignore their competitive threat. So that was weighing on the stock a little bit too. But, you know, we got the sell off because of the trade war today. I think the stock is very, very, very cheap, and I still want to own it here at these levels. Like, I still will probably look to make my position bigger if it goes, you know, sub triple digits. But it's already a, you know, 8% position size for me, so I'm just trying to make sure that I'm not making it too big too soon. Because if we're just on the front end of an escalating trade war, then we're going to get plenty of opportunities to buy the stock cheaper. So that's kind of how I'm thinking about it right now. But a pretty amazingly compelling long-term accumulation opportunity here in Baidu, I believe. So yeah, it's tough because I don't want to be too aggressive too quick, but I think these prices are pretty phenomenal for a longer term position. And again, I do want to maybe make sure that I incorporate the small probability that something really funky happens here with restrictions on Chinese stocks by US investors. What other questions? So someone asked, Yeah. So OCY, you were asking, I think, about Square. You said wanted clarification on what I thought that they could grow at for 10 years. Yeah, I wasn't saying that I thought that they could grow 50% for 10 years. And I don't think any of the analysts really believe that. But if it can sustain greater than 20 to 25% revenue growth rates over the next like 5 to 10 years, I think that will mean that the stock will do quite well long term. Let's actually look up Visa's revenue growth over time. I don't know how much data Koyfin will give us, but yeah, if we go back, Visa has basically grown at, I think, like high single digits, low double digits. Now they're much, much larger, obviously. Like if you go back to earlier days of Visa history, they grew a lot faster. Let's look at, let's see if we can find their growth rate. Let's see. If we look at Visa's, if we look at their 10-year, and their growth rate has decelerated a lot. But yeah, Visa's growth used to be in the 30% range and this is profit growth. Their profit growth decelerated from 30%, it's down to like mid-teens. But like, let's look at the performance of the actual stock. Like, you expect that there's going to be, so here's the stock price, right? So sometimes it doesn't matter that there's some actual revenue growth deceleration or profit growth deceleration, right? Like if they can it's expected that if you're a company that's growing larger and larger, your growth rates are naturally going to come down over time, right? That's what you've obviously read the stuff on base rates, right? Like no company grows at like 30, 40% for a long, long time. Eventually your growth rates have to decelerate as you get larger. But yeah, but the stock price can still do really, really well. It's all about like what your growth rate is that you can sustain over like a long time period, like your average growth rate. So again, I wouldn't expect them to grow at 50%. Square, I wouldn't expect them to grow at 50% for very long. Very few companies ever grow at 50% for more than a few years. Yeah, let's look at their revenue growth rate. I don't know why it doesn't come up when I do that. So let's just look at their sales growth. Yeah, let's take this away. Yeah, I mean, you can see that they decelerated a lot in right after their IPO, and then they reaccelerate growth rates. But I think this company is fine if they grow it, 40 next year and 30 the year after that and 25 the year after that and 20 the year after that. And then they can sustain like 15% growth rates for a number of years. They'll be fine. Oh yeah. And OCY, you were talking about, I guess you were referring to what we were talking about in the channel as well. Eric is asking about Kroger. Kroger is one I took a look at a couple of weeks back. It was, I haven't looked at it in a couple of weeks. Let's see. Is it still declining? Yeah, it looks like it finally found a little bit of a bottom there. Looks relatively cheap, but growth is like really tepid. They've basically been growing at like 0 to 1%. But this stock actually may do okay in a recession because a lot of investors will flee into more stable stocks, like the consumer staple stocks, and grocery store stocks would probably fit that bill as well. People would probably do less eating out and start to cook more. So yeah, grocery stores that's probably why this stock didn't go down a lot today. It was down about 1.5%, which is less than the market. So you can often see these consumer staple type stocks do pretty well in a weakening economic environment. But obviously on a longer term time frame, Kroger's done pretty poorly. I think let's look at their earnings estimates. They've come down over time as well. But yeah, it looks like they're earning about $2 to $2.50 a share. So they're trading at about, 10 times forward earnings estimates, which is a pretty cheap multiple overall. But again, it's a stock that's really not growing a whole lot. looks like a 3% dividend yield. Oh yeah, and this company has quite a lot of debt, so I think that's also a concern and why it also gets a lower multiple. I just couldn't get really. I was just trying to find something that would get me excited about this stock, and I couldn't really find anything that got me super pumped up about it. Like, why would you buy it? Like, why should you own it? Type of thing.
I was thinking, like you mentioned, more of a safe haven if things go south.
Yeah,
I could see how it does have people pile in for that fact because it's not too volatile.
Looks like their revenue growth actually went negative recently. Gross margins look okay. EBITDA margins look okay, or at least relative to where they had been. But yeah, let's see. When it comes to total net debt, looks like they've got about 20 billion of net debt. And they do about 5 billion a year of EBITDA, so about 4 times net debt to EBITDA rate leverage. So that's a pretty high number. It's not like crazy high, but they need to de-lever. They need to bring that debt ratio down over time. Let's look at a cash flow statement. I wonder if they have been paying down any debt. Looks like they are paying down some debt. It's weird too, though. They're still paying a dividend. Like, I almost think that they should cut their dividend and use that cash to aggressively pay down debt faster. They actually they're repurchasing stock, paying dividends. And if they would actually just use those two things and pay down debt more aggressively, they would probably get a higher multiple on the stock. Maybe. I don't know that 100% true, that's 100% true, but I think their leverage ratio is a bit high. So, but yeah, I mean, this could be interesting in a recession type environment. It definitely should be a little bit safer, assuming that I need to look deeper into this revenue trend because I don't know what is causing that to flip to a negative revenue trend. That could be an issue. So yeah, Eric, I'll take a look at that and try to understand it better why their revenue is decreasing. What else? Any other questions out there? I know I kind of hopped all over the place today. Just lots of stuff happening and I was a bit scattered. I know, Nikki, you had been talking about American Eagle. That obviously has been getting hit on the retail weakness.
Yeah. I'm actually looking at it. I was watching it today. I'm considering taking or adding to my position on it, basically averaging down. And I was watching the price action today, and it's as the market was like tanking, it was actually bouncing a little bit, and it broke through a pretty key support level. So I'm going to watch that for the next few sessions, but I am becoming more and more compelled when it comes to the retailers and the trade war issue. As far as what's in my portfolio, Abercrombie, I think they've been moving out of China for a while. I think they only have about 20% of production left in China. And American Eagle, I think that they're a little bit more affected by that. But I think it was talked about discussions with their suppliers and to try to make sure that it doesn't affect them too much. So, obviously that's something that I have considered. But I actually wanted to kind of bring up real quickly Levi because and it sucks because everything I'm seeing, because retail's, everything else is kind of still elevated a bit, right? Except for, the China stocks and in retail, that's what's like showing the value per se. Some stuff is still up there in terms of valuation. But Levi, when I was in Europe, I actually saw so much Levi. Europeans love wearing it or something. And I looked at their results, and it turns out Europe grew double digits for from their earnings report. And I'm starting to look at it a little closer because technically it's actually setting up for a possible double bottom. So I'm watching it to see if we could maybe see if we're going to reverse off of that for a potential swing trade. But it's retail, and I'm I don't know. I feel like I'm stuck between a rock and a hard place because I'm wanting to get involved and take advantage of some of these things, but I'm also hesitant. So, because of everything that's going on, I didn't know if you had looked at Levi, but I actually went into Levi in the U.S. I feel kind of like, I don't know, it kind of disappeared, at least from my perspective. It was kind of the older brand, not as cool. Well, everyone in Europe was wearing it. I was counting the Levi shirts. I was counting the pants, like so popular. And I walked into my first store. I didn't even know Levi had stores. And it was really nice. So I don't know if there's anything there or not. I literally it just came on my radar. So I have to look into it a lot more. But as far as, I don't know. I'm just wondering if there could be something there.
Yeah. Yeah. It looks like the numbers have been pretty good overall. They've been growing over the last 5 years. Profits up modestly. Revenues are up quite a bit. But I know that they've been talked about too as a potential trade war victim. Mm-hmm. Although I think they've shifted a lot of their production to Vietnam and some other places, but the trade war could hit their margins a bit. But yeah, this was a recent IPO. This IPO'd earlier in the spring, I believe.
Mm-hmm. Yeah.
Either late last year or earlier this year. I can't remember.
It was spring of last year.
Yeah. And yeah, it's not at a super high valuation by any means. Trades for what looks to be about a market multiple. Now, growth isn't crazy good. It looks like it's grew about 5% last quarter on the top line on a revenue basis. But
looks like they're when they broke it down, their men's grew 6%, women's grew 16%, and then tops were up 14%, bottoms were up 8%.
Okay.
So they were up in every category, significantly up in women's.
Yeah.
Which is interesting, but it's just one I'm bringing to the forefront, and it's kind of that mix of the technical analysis and the fundamentals as well. But obviously, with what's going on with the trade wars, it can completely negate what's going on with the chart.
Yeah, I would. I don't know. I would definitely keep an eye on it.
It didn't really take too much of a hit today, actually, which is odd. It actually bounced right off of support and ended green. So that kind of got my attention. So I'll post a chart in the chat and keep everyone updated on what I do with that.
It's interesting. Yeah. OCY, you're asking about MCFT. Let me see if I can pull up a good presentation of theirs here. He's asking about kind of what their average earnings look like over a 5 or 10 year period. It's let's see, press releases. I was hoping we could find a presentation here. I was actually talking to a guy on Twitter about this as well. He had some interesting charts on it. I may pull those up here in a minute. Let's see here. Oh, come on. Put in some random info here. My goodness. Just to see a presentation. Oh, okay, great. Awesome. Really good investor relations site here, clearly. Well, that sucks. I was hoping to be able to pull up a presentation. Oh, wait, here's some presentations. Good. I've got a PDF. Because they have some good charts on some of their longer term metrics, which I think are interesting. So you can see that they've grown sales at an average rate of about almost 20% a year over the last, call it 6 to 7 years. And their adjusted EBITDA has basically gone from 0 to 64 million. But it's hard to know how much of that is really based on. I guess the question is, what happens to EBITDA and profit margins if sales get cut in half from here? So it's been great that they've had this like nice steady growth, but it's hard to know, right? Like, I guess, if they were to fall back to like 200 million in revenue, like they were in 2015, let's say, it looks like EBITDA would basically be cut in half, or maybe even a little worse. And so let's assume that flows through to net income as well. Let's look at their estimates, or let's even just look at their income statement. So if we look at last 12 months, it looks like, net income's about 40 million, which is about $2 a share. $2, let's call it $2 a share in diluted EPS, or maybe just above that. So it trades for $15 a share. So it trades at about 7.5 times trailing 12-month earnings. And so if earnings get cut in half, basically then it trades for 15 times earnings. So it still wouldn't be like super expensive. Actually, this says closer to 6 times earnings currently. If we look at estimates, so estimates have this thing continuing to grow and earning $3 a share next year. So if it really does earn $3 a share in the next year at $15 a share, we're talking about 5 times earnings, which is obviously a very, very cheap multiple for a company that seems to be growing year after year after year with strong brands, right? So that's what kind of got me interested. Like, oh man, this thing looks really cheap, and it seems to be able to grow like every year without fail. But again, I think if you hit a really deep recession, this thing earnings probably get cut in half or more, and so. At $15 a share, if earnings get cut in half down to like, let's say $1 or $1.50, you're trading for what looks to be much closer to a market multiple. Now that may be fine. That may be worth paying a market multiple for a company that once it comes out of recession can grow a lot faster, or at least, get back to earning $2, $3 a share. So at some point, I think this might be on the shopping list, but there could be a bit more pain in the near term. But does that math make sense? So like if they're earning $3 a share, $15 a share today for a share, so 5 times earnings. But if earnings get cut in half, you're actually trading more for like 10 times earnings. So we could try to normalize earnings and look at like what their earnings are like on a longer term cycle, adjusted basis. But net, I think the stock probably gets whacked a bit more if we really hit a deep recession. But like on a longer term basis, they claim that, their market share has been slightly growing and that the overall industry's been growing. They've got some new brands that they're rolling out that are a little bit like higher end, participating in some categories that they haven't really participated in as much. Yeah, they bought this company, Crest Marine, which sells pontoon boats. Unfortunately, I think they acquired this company closer to the peak of the pontoon cycle. So that's not great. They should have waited. But the pontoon market, as you can see, has been growing its share of the total market. This is an interesting one to go through. You look at their performance over the last few years, been pretty strong. Let's see what else. Any other questions? Oh, you were asking about competitors to EA. So Take-Two is one. There's a couple of video game publishers that are competitors. Take-Two is one of them. Take-Two makes like Grand Theft Auto and Red Dead Redemption and a few other big games. So Take-Two is definitely one. So one place to see something like this, to see competitors, I like Seeking Alpha. They have a really good section, a peer section here. So like if we bring up EA and then go over here to this peer section and click on it, you can see they often identify Activision, Blizzard's another big one. I wouldn't call Adobe and PayPal direct competitors. So this is actually, all these four are probably not direct competitors. But these two certainly are. The Activision Blizzard and Take-Two Software are video game publishers, and Activision, I think, is the largest one in the industry, and they have a big portfolio of games. They control like StarCraft and what else do they control? They control a bunch of different games. Let's just pull up their investor relations section, see if they've got a presentation. Call of Duty, I think, as well. Let's see. Yeah, they've got World of Warcraft, Overwatch, Call of Duty, StarCraft, Candy Crush. So yeah, these guys have a big portfolio across. They had acquired King, which was the maker of Candy Crush, a few years back for like a really high price, like $6 billion or something. I don't know if that acquisition actually paid off or not. But yeah, this is another big competitor. I haven't looked at their metrics in a while. Let's take a look. So Activision, let's look at how they've been growing. Looks like their revenue growth has decelerated some. Let's look at like they were growing mid-single digit revenue growth. It looks like actually looks like it's still pretty good. They have these lumpy years, so they grew 40% in 2016. That may be acquisition related. I'd have to go back and look. Or it could have been a big Call of Duty release or something like that. I'd have to check. Pretty good numbers. Looks like trades for about 20 times earnings. So it's got a higher multiple than EA right now. Balance sheet wise, looks like they've got a little bit of net cash. Looks like, looks like a little bit of maybe $2 billion in net cash or so. And stock's down quite a bit in the last year. Video game publishers, Take-Two, I think, kind of stalled out as well. It's actually done pretty nicely over the last couple months, but it had been down. So if we look at estimates on Activision, yeah, Activision's earnings estimates have come down quite a bit. That's why the stock's down so much. So now they're expected to earn somewhere between $2 and $3 over the next few years. So that's that's what, like basically just above the market multiple or so. Now Take-Two, let's look at their estimates. I don't always put stock in analyst estimates, but it's just always a good gauge, like a starting gauge sometimes. So yeah, they're expected to earn somewhere between like $4 and $6 over the next couple years, and they traded a higher multiple. They traded about about over a 20x multiple on forward earnings estimates. The thing that I was always worried about Take-Two, so they have the Grand Theft Auto franchise, which was basically one of the largest games of all time, and in terms of earnings, but it looked like it was starting to really tail off. So I don't know when their next refresh of that game is, but the revenues from that game are starting to tail off quite a bit, which may be why their earnings estimates have come down so much. But they were pretty dependent on that game. So that was one of my issues with Take-Two. So when you look at something like Take-Two, which has a, kind of a one-off hit like Grand Theft Auto, I don't know. It's possible that Grand Theft Auto will have like a long tail of earning, great revenues and profits. But EA has these franchises in FIFA and Madden that like year after year seem to continually produce great results, because they can always refresh the content, refresh the players, refresh the ratings on the players and the, players' attributes and things like that. So there's constant refresh of content and added game modes and things like that. So that's why I like a lot of the profile of EA's core gaming business, because it's not as hit driven as some of the other game publishers. But obviously the mobile side for them has been a problem. So on that side of things, it's definitely less sticky revenue. And again, the other thing about EA is that it trades for a cheaper multiple. It trades for, especially if you net out the cash, they've got, $5 billion of net cash on the balance sheet. If you net that out, then it trades for like, I think 14 or 15 times earnings. So if we could pick up EA and at like a 20% discount from here, I think it would be pretty compelling. But yeah. So that's just some of the stuff I'm looking at. I'm thinking about, like I said, Blue Apron tomorrow. So Blue Apron, we're really going to get a good look at what their turnaround situation looks like. You know, is it continuing? Are they continuing to generate, positive profit? What is the new CEO? What is she going to say about new initiatives and how the business is doing? Like this is a big one for Blue Apron. It's a big data point in understanding if this turnaround is actually going to happen or not. So that comes out tomorrow. I believe before market open. Let me just double check. Let's see. Looks like, yep, prior to the opening of the U.S. markets. So tomorrow before the open, we'll have information on Blue Apron. Stock was up today, I think. Is that right? Yeah, it was up slightly, I believe. It sold off throughout. Sold off over the last week or so, but it was, I think, part of that may be, it's weird that highly shorted stocks often go up on big market down days because investors are reducing risk. So they're getting out of shorts and they're selling their long positions at the same time. So that's always funny to see. Yeah, Blue Apron was actually a little bit flat today, but better than the market. Of course, it's done a lot worse than the market over the last year. So yeah, I'm interested to see. I think, this thing can fly if, depending on what results look like. So that'll be interesting tomorrow. But yeah, lots more other companies reporting this week, like I mentioned. So there's going to be a lot of company specific news and probably some more trade war news. So exciting times in the stock market. Luckily we have, or at least, hopefully you've got some cash in your portfolio to take advantage of some of these opportunities. All right, y'all. Well, I think that's it for me today, unless anyone else has anything, or Nikki, if you have anything else. Cool. All right, y'all. Have a good one out there. Hit me up in the channel if you have questions.